Yeah.
Oh, perfect. So, so that's my introduction slide. Basically, if you have not attended my last session, just a quick overview of my introduction. I'm a practicing accountant and tax advisor in UK, registered with the International Accountant Body. FAIA is my fellow membership. And then I'm also chartered accountant in India. I have a practicing firm in India as well as in UK. So that's my QR code to save my contact if you have not saved my contact into your phone book. Because if you want to receive a WhatsApp notification from my upcoming events, then you should save it because it comes as a broadcast list. But today's topic is very interesting because it's a wider subject. It's very difficult to cover in 30 minutes scenarios, but I will try to capture the audience's queries which I have received in advance. Okay, so mostly I'm going to cover the area of UK tax implications, although there are some impact on the Indian taxation aspects. Um, but again, if you have any queries from Indian taxation aspects, you can just enter your query in your form. I can directly give you overview of the Indian taxation for any remittance. Okay, but I will briefly cover what are the tax impacts in India also. So this was my last slide in the last presentation. So when you are actually filing tax return in UK and how it's going to impact remittance of fund, it's only going to impact to the UK resident. And the definition of UK residents, it's a three-step level flow. So it's not very straightforward like in India, like you stay more than 180 days and you becomes residents. It is one of the question, but it's not straightforward. So you have to follow this three steps flow chart. So if you want to do your self test, there is a link in the below. Um, but I have my YouTube recording separately to explain all the scenarios. What is UK automatic test? What is sufficient tie test? Um, they are broader subjects. It will approximately a half an hour video is there to understand how you can actually uh, take your status whether you are a UK resident or not. Okay. So being a UK resident, your tax in UK is chargeable to global income on arising basis. So what is mean by arising? Arising means even if you do not bring the money, it is taxable.
Mm.
Sorry, if you are not speaking on the, you can mute yourself. Okay. So I, I request to mute if you are not speaking. Um, so now what is the remittance basis of taxation? Okay, this is only going to be applicable for 24-25. Sorry, again, there's a noise coming up.
Rajiv, you can mute everyone.
Okay, let me see if I can mute. Hmm, I'm not getting the option. Right.
I think the
I,
person has muted
yeah.
himself.
Muted himself. Person itself muted. Yeah.
Okay, okay. So remittance basis of taxation, it's only going to be applicable for 24-25. From 6th April 2025, there's going to be new budget rules going to be applied. There's a news you have already heard about this. If you have not heard about this, this is going to be obsolete, but still you have 1 year to opt for this scheme. What is this scheme about? Like now, being a UK resident, but not domiciled. So not domicile, there's a definition of what is not domicile. Means basically, one quick test is like now if you have a back home in India and you treat that as a main home in India, then you are not domiciled in UK, but still UK resident. But there are other criteria also, like deemed domicile, which is means if you have been living for certain years, you can become a deemed domiciled. Then uh, you will not be able to opt for this. So again, there is a reference link on the gov.uk how you are deemed domiciled. But I will just quickly cover because this rule is going to be obsolete after this year. But if you are opting for this remittance basis, then you're if you are bringing any if you're not bringing any fund for on like income from overseas, then it is not taxable in UK. So unremitted fund, what it means, suppose you have earned, example is like suppose you have earned a £5,000 in India, and if you are not bringing that money to UK in that tax year, and if you are opting for remittance basis, you are not going to pay tax on the £5,000 in India. But there is an impact on your personal taxation in UK. You're going to lose your personal tax-free allowances, which is like 12,570 currently. So you will lose that. Now also you will lose annual exemption of capital gain. If you have any capital gain, you will lose the annual exemption allowances. And this is not a by default option. You have to file tax return to take this option. So there are three criteria here I have mentioned on this slide, right? So what is the tip from my side? If your foreign income and gain is over 12,570, or your current UK income, let's say if you are earning salary more than 125,000, then this option is beneficial for you if you are within 7 years of staying in UK. Okay, this is just a tip from my side. Okay, but it is again only available for 24-25. Okay, three bullet points again in bottom. You need to pay remittance basis charge if you have overstayed more than 7 years. So what is remittance basis charge? Because on top of your tax, you have to pay fixed fee 30,000 or 60,000 based on your number of years you have stayed over 7 years. You have to pay RBC charge. Okay, and if you bring those allocated money in later year, you have to pay tax on remittance basis. What it means, although this rule is going to be obsolete after 24-25, but let's suppose you have opted for this year and you had a 30,000 foreign income, and you said that no, I have opted, I'm not going to pay tax on 30,000. Now in next year, if you are bringing that 30,000 money, you will have to pay tax on 30,000 because it does not matter whether you are opting for remittance based in next year or not, okay, or the rule is valid or not. Still, you have to pay tax because you had this deferred this income, which remittance basis means you are deferring the income for the future year. So you are saying that I will pay tax only when I will bring money in India. Okay, so hopefully I have covered these scenarios. Next one is
Just,
yeah,
Rajiv, if you don't mind, on the
yeah.
slide
Hmm.
remittance, you're saying that if suppose I have an income of £15,000 and I'm saying I'm going to bring it on remittance basis, but now I'm in year 10 now.
Mm-hmm.
So you're saying that if I declared that 15,000 in year 5 and then in year 6, year 8, I need to pay £30,000 additionally on top of 15,000 tax on 15,000 if you want to bring it.
Correct.
That's more than what the money is.
Yeah, so you should not opt for that. Then it is scenario is not better for you. Yeah.
Okay, unless it's like £1 million or something like that, it doesn't make sense then.
Yeah.
Okay. Thank you. And somebody asked a question in the Q&A, I think.
Actually, I'm not able to answer question right now because last experience and feedback from everyone. I will cover all the slides, and then if we have a time left, we will answer the question. Otherwise, I will answer questions in a direct your email if you have entered the question in
I
your.
don't want to watch it.
Thank you.
Okay.
Human.
Thanks,
I
Rajiv.
think it's person.
Exemption of a small amount. This is the case of one scenario. If you have a small earnings and if you are remitting that earnings to UK, it is not taxable. No need to claim remittance basis. This is the option available, and no need to file tax return also. What is that? This you should meet all the conditions below, right? So if you are resident in UK but not domiciled, And if you are employed in UK and you are earning a lower bracket income, which is 20% scenario, um, including all worldwide income. So you are under 20% bracket, and salary from overseas is just a 10,000, below 10,000, and interest from your overseas bank account is just below £100, and no other overseas income. So if this you are meeting this all criteria, and if you are bringing that overseas income into UK, you are categorized as a small amount. Okay. So this is for financial year I'm talking about. Okay. So you don't have to claim remittance basis for this, and you don't have to file tax return because you are under lower bracket of 20% salary bracket. So, and your income in income from overseas employment is below 10K. Okay, not other income like capital gain. I'm talking about only if your overseas income employment from overseas salary and bank interest is below 100. Then in that scenario, you are categorized as small amount. Okay.
Just to clarify, this overseas employment is only employment, not like rental income or
No,
something
no,
like
no
that.
rental income, no self-employed, no business, no capital gain, nothing.
Okay.
You just have a simple job in outside UK and also in UK, but total income altogether you are under 20%
Okay.
bracket. Okay.
Got it. Thanks.
This is the one scenario is if your income, unremitted income in overseas is below £2,000. Okay. This is available to all residents. You do not have to claim remittance basis. Again, being myself also, if I have stayed more than 7 years or I'm a British citizen, and even if I'm on domicile, I can opt for this. If I have unremitted income, okay, which is like below £2,000 in all the countries overseas income, right? And if you're not bringing that money to UK, I can claim as a you do not have to claim. It's applies a default remittance applies rules to all residents. Okay, no need to file an even tax return also, unless other reason you have. So if you have just this below 2,000 income and just salary, no need to file tax return. Again, salary if your total income salary is below 100,000, because if there is other reason to file tax return, like if you have more than 100,000, then you have to file tax return in UK, right? And also there's a good advantage, you're not going to lose personal tax-free allowances in this case, right? So even if you have claimed that, okay, I'm not bringing the money below £2,000 because I have only £2,000, below £2,000, and so I'm not going to pay tax, right? But if you have income just of £1 or over, like, let's say £2,001, you have to pay tax on total £2,001. It's not, you cannot say that first £2,000 is tax free. Okay, so you have to consider this point. Next scenario, transfer of clean capital. Most of the people do not know about this. What is clean capital meaning? It's a pre-arrival tax planning. When you come to the UK, before that you should plan this. Okay, after coming to UK, it's very difficult to plan. Okay, what is clean capital? Again, it is applicable to resident but not UK domiciled. Can be remitted, sorry, spelling mistake is there, can be remitted to UK without any tax consequences. If you're opting for remittance basis in any of the year, and if you're bringing that clean capital, you are not going to pay tax on this. Okay, so what is the clean capital means? It's a pre-arrival money which you have kept in the ring-fenced bank account. What is the ring-fenced bank account? Before coming to UK, you have to freeze your bank account so that you should not mix any other fund after once you landed to UK in that bank account. So suppose, I know in India, there's no current bank account concept at the moment, right? But some banks have started doing this ring-fenced banking. So, but again, if you have a saving bank account, there is some minor exception can be allowed, but you should not mix any other incoming fund or any other fund in that bank account after you landed to UK. Just exception could be the interest earning in that account. So whatever interest you are earning afterwards in that account, that will be definitely taxable, but still that capital amount will be clean capital. So if suppose you land in June, 1st June you have landed to UK, 1st June 2023, and you I would suggest to open a new bank account for any other incoming into your Indian bank account after that date. Okay. So that's mean you are keeping that account as a clean capital. Hopefully I'm making sense for this. Okay. So in that case, if you are claiming remittance basis, and then even if you are bringing that clean capital, you are not going to pay tax. Again, remittance basis, this option is going to freeze after 2025. So this advantage can be for this year only, but next year also the rule will change and we will have some advantage for clean capital. I'm not going to suggest for 25 onwards. This is for 24, 25 only. Okay.
One question, Raju, on this.
Yeah. Yeah.
The ring-fenced bank account can't be created once you stay more than 12 months in UK.
No, if you should do this before arrival to UK.
Before arrival only. Okay.
Or
thank you.
existing bank account you can freeze. Freeze means you should not use at all after you coming to UK.
Mhm. Okay. But this
Yeah.
option is only before arriving to UK, we need to plan.
Yeah.
Okay.
Even if you have FD, you can ask the FD bank that do not credit any interest in that, interest credit in separate bank account. And if there is FD, it should be, if it is maturing, it should be transferred to that account which has no any other income after arrival to UK. So it's like an old bank account. It's very proper planning. We have a proper advice planning for any high net individual worth of people who are coming to UK, so that you can take advantage. But again, this is for this year only. For next year, we will have a separate planning for the clean capital.
Thank you.
Sorry, Rajiv.
Yeah.
Very quick question on the previous slide.
Mhm.
The one that you spoke about, £2,000 limit. The previous
Oh,
to this. I'm sorry. Yeah.
okay.
So if there is a income from rental for a property which is in joint name
Mhm.
for two people who are in UK, will this value be £2,000 per person, and will this be 4,000 for the rental income property?
Yeah.
Is that
Yeah. Correct.
correct understanding?
Mhm. But on rental income also, if you have no other incomes, you have 1,000 of tax-free allowances. Just to consider, if you are showing to income in rental income, okay, if you have more than let's say £3,000 per person, income £6,000, you can claim 1,000 tax-free allowances for rental income. It's called trading allowances. But again, that is a separate part of planning or rental income. But yes, if it is below 2,000 per person, you will be able to claim that.
Okay, so if only if it is in joint name and we are getting the
Yeah.
rental from the same
Correct.
property.
Correct.
Okay, thank you.
Interest from the bank saving account in India. There are three types of bank account in India: NRO, NRE, and FCNR. NRO is normal saving accounts where you have interest coming in and tax is chargeable by India. But NRE, there is tax-free income on interest, and FCNR is also tax-free in India. But in UK, all are taxable. Okay. So now the consideration is how the NRO TDS has been deducted by India. Default 30% TDS is deducted, but you have to speak to your bank advisor telling that you are UK resident, should not deduct more than 15% as per double tax treaty signed by UK and India. So you have to provide your residency proof to your banker. Then afterwards, they will not deduct more than 15%. Okay, but I have illustrated this scenario on the assumption that your bank of NRO is deducting 30% TDS. So there is a table of illustration. I have tried to explain, like NRO and NRE situation. If you have interest income in equivalent of £5,000, the 30% TDS will be deducted by your banker, which is £1,500. Okay, but in NRE, it will not be deducted on that, and there is a zero tax in NRE, right? So in UK, you have to add income 5,000 in both scenario. UK tax will be calculated assuming that you are in higher bracket, 40%. So 40% of 5,000 is 1,800. So UK tax is calculated 1,800 in both scenario. You can claim FTCR. It's called foreign tax relief.
Ramesh, can you mute yourself, Ramesh?
There is a background noise from Ramesh. Someone called. Can you please?
Can you
Thank
please
you.
move it if you are not speaking? Right. Okay. Okay. So this illustration again I was talking about. So in both scenario, you are paying your UK tax calculated is £1,800, and you can claim FTCR. FTCR is the double tax agreement, which is again 15% is the limit. You can claim relief. So 15% of 5,000 is coming up 750. So you can reduce the 750 and net tax is payable 1,050. The great advantage in NRE is that even if you are not paying tax in India, you can still claim foreign tax relief, which is 15%. It's called deemed FTCR. To qualify for deemed FTCR, your NRE account should be not more than 10 years. Okay. So once you open account in India, you should not hold that NRE account more than 10 years. Again, there is a loophole in here. If you have account for, let's say, completing 10 years, close that account, open a new bank account with the new banking provider. Okay, because double tax treaty refers that you should have an NRE account only within 10 years. So there's no clarification on this. So you can open a new bank account and you can still take the advantage if your account is not more than 10 years. Okay.
Rajiv, one question. So when we are going to sell any kind of shares or mutual funds back in India, how that, because what will happen is at least on the dividends, before paying the dividends, even the companies are going to deduct 20% or 30%, whatever it is for NROs, right?
Yeah, this you can still claim the FTCR. You can refer my last webinar about the UK tax on the shares trading. So yeah, if you have any dividend income, you can still claim the FTCR on dividend. And if you have any capital income, also you can claim the FTCR. There is no limit on the double taxation agreement side. In interest side only, there is 15% limit. Okay, but if on the capital gain side or dividend side, whatever tax you have paid in India, that you can claim FTCR subject to the maximum limit of UK tax. Suppose UK tax is coming £100, and if you have paid £120 in India as a tax, you can claim only up to £100, which means your UK tax payable is 0. Okay.
Okay, thanks. I think that would be helpful.
Yeah.
Can you explain, Rajiv, that 750 and 1,050? How did you come in? How did you calculate that? 750 is what's the basis for 750?
750 is 15% of 5,000.
Okay.
So
And then
on
1,000?
1,050 is 1,800 minus 750.
Okay. So the 1,500 that we already paid
So
in India, can't we claim the full 1,500 on the 1,800 in the first scenario?
no, that's why
NRO
I'm
scenario?
saying that's because you have advantage there to call banker to say that don't deduct TDS of 30%. As per UK, it's only 15% allowed. So going forward, they should only deduct 750 from you. So that's why you are allowed to claim 750 as FTCR. Another things, if you have for last year 30% is deducted by bank, you can file ITR in India and you can get the refund. So that is possible. So if you have, let's say you have been charged 30% higher tax, file in ITR in India, you will get the refund for that extra tax. As being a resident in UK, you should not be charged for more than 15% interest on tax on interest. Hopefully,
is 15% standard for interest and any of the gains that we make?
No,
like
only
selling, only on interest.
Only on interest. Okay, the double tax treaty is only on only on interest. This another scenario I'm going to explain about the PF Provident Fund, because one of the question was from the Provident Fund. So if you have Provident Fund before arriving to UK, like employment from, and you want to redeem that Provident Fund, but you become a tax resident. So if you become a tax resident and if you are redeeming that Provident Fund, even though you are not bringing that money, that fund is taxable in UK. But it is tax-free in India as per Section 10, but it is taxable in the UK. So how to plan this better if you are going to redeem Provident Fund? Okay, there is a treaty again pre 6th April 2027. So any accumulated fund till 6th April 2027 is not taxable in UK. So suppose you have a 10 lakhs rupees in your PF account on 6th April 2027. Okay, and now you have a 20 lakhs today in your PF account. So you have to download the statement. So up to 10 lakh is tax free. Okay, balance 10 lakh would be taxable in UK. On the balance 10 lakhs, 25% you can claim a lump sum tax free allowances. So out of 10 lakhs, 25% again you can claim. So left over 750,000 rupees. That going to be taxable in UK. Okay, this is the illustration I tried to explain here. Okay.
You say 2017, not 2027, right? You said 2027, but written as
Yeah.
2017. So
2017, yes, it is in 2017. So any accumulated fund, because there was an agreement between UK and India, any accumulated fund till 6th April 2017, that would be base income of PF will be tax free. It's called clean capital again in that scenario. So till the accumulation of any fund till the 6th April 2017, that will be completely tax free. Any delta afterwards would be completely taxable in UK, even interest plus capital both will be taxable in UK. But you can claim 25% lump sum allowance. Okay.
What do you mean by capital, Rajiv? Like, for example, if my contribution is, let us say, 50,000 rupees in India. Okay, that is my personal contribution. So that means per year it will be about 6 lakhs or 6,000 pounds. Okay, on that 6,000 pounds, if I'm going to earn an interest of, let us say, 500 pounds, you are saying that both 6,500 is taxable.
Yeah. So including capital and interest will be taxable. So
technically speaking, I'm not supposed to put any money in PF going forward. Technically speaking.
Once you arrive to UK, you should plan clean capital. Okay. And then you can ring fence that bank. Please mute yourself if you're not speaking. Okay. Hello. Can you please mute?
Please finish my song. We did the other one.
is there any way to mute?
Yeah, I have muted all. If you want to speak,
definitely
yes,
the noise is not from my side, but yeah.
Yeah. So I was saying, if you have a PF money and you should do the pre-arrival planning, okay, before coming to UK, you can freeze as a clean capital. Then you can bring anytime in future that PF money, pre-arrival money, okay, on a remittance basis.
But I think it is a big subject. Probably I need to speak to you in person.
Mm-hmm. Right.
So one question, Rajiv, if you don't
Yeah.
mind, only one question. If you're not done the pre-arrival freezing of the account, PF account, because PF is government control, we can't freeze it, right? But this law, whatever the calculation you told will still apply until 6th April 2017, whatever the PF amount is there, that is not taxable.
Correct.
Okay, that's fine. So we haven't frozen it, but you can still
But after
use
2017 also, let's say you came to UK in 2023. Okay.
Yeah.
Before that date, it should be not taxable in UK, right? Because that was your previously earned income in PF. Okay. So in that scenario, you have to plan in such a way that within 30 days of arriving in UK, it's a pre-arrival planning. You have to pass this fund to a ring-fenced bank account. It can become a clean capital. Okay.
Okay. Okay. And you're saying anything after 2017, 6th April is taxable. And if I paid the tax in India, then once again, can I claim a deduction?
No, you cannot claim deduction from UK income on the paid tax before in India for past years. Only during the tax year. Yeah, and during the tax year, you can claim any tax paid in India on your salary income.
No, for example, if I came in something like, say, 2010, and I was here, say, until today, and but because the employment change happened, and from 2017 onwards, there's no contribution into the PF, but the interest is getting paid into the PF.
Interest will be taxable, but capital will not be taxable. Yeah.
So interest will be taxable. So if we withdraw today the amount from the PF, even in India, the interest will be taxable, because after what the rule applies, if we pay tax in India for that interest amount after 2017.
As far as I remember, a PF fund maturity is tax free, even though interest in the section 10. But I will reconfirm from my Indian partners. But it is tax free in India.
What I understand is it's taxable, because it's only interest I'm earning. So it's taxable kind of.
No,
That's-
no, no.
Okay.
It is
That's
not
what I was telling.
taxable. It is not taxable. So in India, if you are going to earn or if you are going to contribute more than 2.5 lakhs per year, whatever may be the interest that you are going to earn on top of that 2.5 lakhs is taxable.
Okay, so there are various
Correct, but-
types of provident funds. So if you are limiting that, maybe that's chargeable to after that scenario. Okay.
So in that interest charge, suppose in case, assume that the taxation is there. If I pay tax on the interest
You
amount
can
from
you
after
can claim the
2017,
you can
claim
claim
the
FTC.
FCA.
Yeah.
Okay. Thank you. Thanks, Ramesh, for the advice. Also.
No worries, because even I need to speak to Rajiv on this particular thing because I have a pretty huge sum in my Indian PF.
That's a
Okay.
confusion actually.
Yeah.
Rajiv, I asked you earlier also, maybe not today, but cover. There are 3 more things like PPF money in the bank account, gratuity, and leave encashments. Around that, how people should plan.
I could have answered this query, but you have not given me in advance. But it can. Right now, we have only 5 minutes left, right?
So, maybe
Yeah.
through mail or we'll talk, Rajiv.
Yeah. Okay.
Or maybe add a slide, it will help others when you share the slide.
Yeah. Sure. PPF would be taxable in UK as per but gratuity there is some tax planning involved. And what was the third part?
Similarly, leave encashment when people are moving that particular area, if leave encashment happens.
Okay, encashment is going to be taxable in UK.
Okay.
But on gratuity there is some planning involved to minimize the tax.
Sure. Okay.
Fund transfer from parent. We have only 3 minutes left. Okay, very quickly. Fund transfer from parents as a gift, or if you are selling any real estate in India, which real estate was gifted to you or inherited from your parents. In that scenario, firstly, any gift from the parents is non-taxable in UK. Okay, first point. Okay. When you are sending money from your own bank account to UK, Indian bank account may deduct TCS. Okay, just don't confuse with the TCS means they are deducting tax to avoid any hiding income, but you can claim that refund in a ITR of India. Okay, NRO bank account may ask you to additional certify like 15 CA and 15 CV by CA in India or A2 form, which we can also assist if somebody wants to get help. Gift can be subject to IHT, inheritance tax. It is in addition, it is not income tax, it is inheritance tax if something happens to your parent within 7 years. Okay, so once you receive the gift after date within 7 years, if something happens to your parent, that fund will be counted as estate money, and if your estate fund is more than certain limits, you will be paying inheritance tax in UK. Okay, if you are selling property and suppose that was gifted to you or inherited from your parents, so cost price of the property would be fair market value on the date of gift or on the date of inheritance. So for example, in 2002, you have received a property from your parents as an inheritance or gift, and 2024 you are selling. So let's suppose 2022, the fair market value was 2 lakhs. So that would be your cost, and you are selling in 10 lakhs. So 8 lakhs would be profit. So 8 lakhs profit would be taxable in UK. Hope I have explained this scenario.
Yeah, very quick question on this, Rajiv. If a property is bought 50-50, 50% from the money given by the parent and 50% money from yourself, sending from UK to India, and then we buy the property together, and say we sell this after 5 years, how is that dealt with? Do we have to pay 50% on the gift tax as well, and then on the capital gains as well? How
See,
is that?
If you have received contribution 50% from your parents to buy property in UK, okay, firstly you have
In
to
India,
analyze.
property in India.
Oh, in India. Okay.
Yeah.
So whether you are registered owner or your father is also a 50% registered owner.
No. It's completely as a gift to us. And
okay, in that case, you have to pay tax yourself on the full gain. Gift will be not taxable, but your total cost minus your gain income would be taxable in India and as well as in UK.
Okay, got it. Thank you.
But Rajiv, let's say if you get some gift or money from your parents from India and you want to bring in UK, how much you can bring, and do you have to pay a tax on that?
No. In UK, you don't have to pay tax on any limit of the any limit. You can bring that gift. Any.
You can bring any money, like
Yeah,
even
yeah.
1 crore or whatever.
Yes. Only in India, your parents have to pay. You have
Pay
to
the tax there.
TCS is something, you know, to control tax avoidance, which means suppose your parents has 1 crore and they want to give it to you, right, as a gift. Firstly, bank will deduct 20%, okay, in TCS, and your father has to disclose in ITR that how that 1 crore has come, okay. But for you, it is not taxable in UK.
But even he's not working, and let's say he's selling some land or something, even
Yeah,
they have
that
to
is
pay
fine.
tax?
Yeah, they have to pay TCS first to bank, and they can claim that refund. If you say that there's no income, you can claim your father can claim refund in ITR in India.
Okay, because he's not filing any ITR, he's retired,
So
right? So
he
that's
has
the
to
reason I
file.
asked.
He has to file ITR in that case.
Okay, then he can get the money back returned.
Yeah.
But
Okay.
if it's a tax paid income that the parents have, even then they have to pay
Yeah.
tax again on it.
Yeah, because TCS you have to claim refund, right?